Today we're looking at a company that pays a 4% plus dividend yield, has a 21-year history of raising their dividend, so a long history. And here it is, it trades at something like 4 times free cash flow. Super cheap. So you might be asking yourself, well, Daniel, what's the catch? The catch is that it's an oil play. And yeah. My name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. And you might be saying, wait a second, Daniel, there's no way oil can be unrivaled. And largely, I agree with that take. These aren't going to be exceptional companies. These are commodity players. Maybe you can find a low-cost producer that's going to win no matter what the environment, and they're going to be unrivaled on a price basis. But generally, it's a lousy sector to invest in. And so the question is, and this is a billion-dollar question for you to be thinking about, at what price does a crappy industry become an attractive investment? At what point do you sort of cross the Rubicon where you're saying this is now compelling, even though it's a lousy sector, even though it's a lousy business? Let's dive right in to understand what this company is, what do they do, and sort of the setup here. Here's the disclaimer. You can read on your own time. And so, yeah, I did a prior video with Nelson from Open Square Capital where he makes the case that forget $80 oil. We're looking at $100 plus in the months ahead. Now, even if he's wrong, I'd argue here's a play that you can potentially still win. And once again, at what price is an oil producer too cheap? And the company we're looking at today is called Canadian Natural. CNQ is the ticker. They trade in both US and Canada. And an overview of their assets, they're predominantly in North America, producing around 1.2 million barrels of oil equivalent per day. About a quarter of that is natural gas. About 50% is light crude oil and synthetic crude oil, as well as heavy crude oil as sort of the rest, along with the oil sands mining. And so that's what you're looking at with this business. The reason why it's critical to understand where do these assets come from is it's because it's in a country, or mostly in countries, where you're not really worried about, hey, will the country sort of appropriate these assets? Will they take them away? This isn't in a, let's say a Latin American country where you're worried your assets are just going to disappear overnight. So predominantly their assets are in North America, some in North Sea and off the shore, offshore Africa, but predominantly in Canada. Now, this is the slide that really gets me interested, showing that, look, at $66 West Texas Intermediate, they could generate $13 billion in free cash flow. Now, keep in mind, currently, WTI is currently trading at over $80 per barrel. So this implies they're trading at 4 times free cash flow, the cash flow that they expect they can generate even after paying for their expenditures to sort of keep up their production or even increase it. So they're saying, 4 times at $66 per barrel. At 80, they might even be closer to 2 to 3 times. So then you're like, whoa, 2 to 3 times free cash flow. Will shareholders actually get that free cash flow? And yeah, they have a history of returning cash flow to shareholders. 21 years of consecutive dividend increases. They recently raised their dividend 11%. At the current prices, it yields 4 to 5% yield. And they have a history of returning cash to shareholders, not only through dividends, but also through buybacks. They're currently returning about 1% of the common stock per quarter to shareholders. So that's a 4% on top of the 4% from dividends. And it doesn't stop there. They're saying, we're repaying our debt. So that way our debt will get to about $15 billion in total debt by the end of this year. And once they cross that level, then they're like, we can return even more to shareholders. So if you have a company that's trading at the equivalent of 4 times free cash flow, and you can return the vast majority of that to shareholders, wow, that could be, 10-15% yield to shareholders potentially starting next year. And they're not only investing in terms of growing their business, or at least keeping it stable, but looking to also become more competitive. And you've seen that with their operating costs, bringing effectively how much it would cost for them to produce a barrel in their oil sands assets to around $15 to $20 per barrel. So even if oil prices were to go back down, they should still be lucrative, still be prosperous, making money. But then, this is where the high growth oriented investors say, well, wait a second, I wouldn't touch oil with a 10-foot pole. Here it is. You have Kathy Wood saying, isn't this going to zero? It's going to have the same fate as whale oil. And I'd say, well, maybe she's right, 10, 20, 30 years down the line, but we're just nowhere near that. I mean, let's look at the actual daily, not even annual, daily consumption of 100 million barrels per day. in terms of world consumption. I mean, that we are so far removed from that idea of completely cutting consumption to cutting this to whale oil. I mean, it strikes me sort of as preposterous to even make that comparison. Now, maybe it does sort of decline over time. And believe me, I definitely appreciate that. I want to invest in things that are sustainable. And this is not sustainable. This is unsustainable energy. You know, you're pulling things out of the ground. But I am looking at this thinking, yeah, we're well on our way to passing our previous highs in terms of world consumption. You know, 100 million barrels per day plus of world liquid fuels production and consumption. And it's likely even getting worse right now as we're facing a global energy crisis. Once again, I called that out in the previous video with Nelson and Open Square Capital. You know, here it is. You see several markets around the world facing either a coal, energy crisis or a nat gas energy crisis in Europe. Effectively, folks are saying, hey, we got to switch away from gas and boost our oil demand. And another key risk, so as if that wasn't enough for you to be worried about, sort of saying, hey, isn't this going to go to zero over time? Another key aspect to these businesses is that they do have to replace their assets each year. That means they have to run faster and faster just to sort of stay in place. And that's a tough part of this business. Here it is, Canadian Natural. They decline, their assets decline in terms of production at about 10% per year. So that's a tough hurdle. Imagine you having to be able to run faster 10% each year. I mean, you cap out at a certain rate. And so that alone should warrant a lower valuation. But that becomes the billion-dollar question. What's the right price for a low-cost, commodity-driven player? And, Howard Marks has a famous phrase where he goes, any asset at the right price can be compelling. Paraphrasing here. And so I'm asking you that. At what point do oil companies start becoming compelling? Where you just sort of say to yourself, okay, the risk-free rate is 2% that I can get on my treasury bonds. I'm actually losing 3% in real purchasing power because inflation's 5%. So I'm really losing like 3% of my money each year. Okay, so if I really want to get a satisfactory return, it needs to be 5% at least, plus whatever sort of risks. So maybe 5 to 10% yields. So then you sort of say, okay, I want a fantastic return. I need 15%. Well, at what point does a company like Canadian Natural start becoming appealing? Does it have to be a 30% yield? Does it have to be a 100% yield? So that's the question that I think every investor, and that's the global marketplace, is going to be considering. Wait a second, I can get a 4% dividend yield from owning Canadian Natural? It starts raising that question when you see this and when you see, based on oil at these prices, this company is going to be minting free cash flow. That's a tough one to answer. Now, I personally, if you want to follow my personal journey, go to unrivaledinvesting.com, click join the journey. At the end of each month, I call it a potential multi-bagger, where I'm looking for those types of companies that could potentially go up hundreds or even thousands of percent over time. I'm generally not calling out companies like this. I'm looking for companies where ideally they can build their business each year. And that's the reason why software companies get much higher multiples. They don't have to deal with this sort of running in place risk of like, oh yeah, this business, where our asset base is declining by 10% of the year. If anything, their asset base is building by 5, 10, 20% a year as they grow new customers, and those customers are really sticky. So yes, part of that valuation premium is warranted, but part of me also wonders, and I do have a little bit of a contrarian streak in me, I'm wondering, is oil really the smart play for investors to be considering right now, just because it's so hated? And you see these numbers and you see 20% yields. You see, effectively 2 to 4 times free cash flow. And you see investors effectively saying, yeah, this is going to zero, yet there's 100 million barrels per day in consumption. And I'm looking at this, I'm thinking, investor sentiment might be starting to change. And you see it with the prices. And even if prices don't go parabolic, sort of like what some investors are expecting, sort of saying, hey, there's a supply-demand imbalance. This could go to 100% plus, maybe 200. This just stays where it is now, even goes back down to 60. That still strikes me as a home run for a company that could be generating 20% yields. So let me know what you think. Have we crossed the Rubicon in terms of sort of saying this space, it might be worth investing now because it's so cheap? I haven't pulled the trigger, but if I do, I'll call it out. Probably on my exclusive server on Discord, or I'll do a weekly update. It'll be one of those. You could check that out on unrivaledinvesting.com. I'd love to hear your thoughts. So please post below in the comments of this video of whether or not you think you might pull the trigger for either Canadian Natural or oil in general, just given that how many investments can you find that trade at 4 times free cash flow? Thanks so much for watching.